Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
Good morning.
Today, on our deep dive, we're looking at a whole raft of reports, mainly from Bloomberg and MarketWatch, really trying to piece together the global economic picture right now.
Yeah, it's quite a snapshot. We've got central bank moves, trade tensions heating up again, market reactions. It's all connected.
Definitely connected. We want to unpack what these headlines mean for you, the listener. So let's dive in. China seems like the place to start, wouldn't you say? A lot happening there.
For sure. Bloomberg's reporting China just cut a key interest rate and their reserve requirement ratio. Big moves.
Okay, let's break that down. The rate cut, it's the 7-day reverse repo rate. What does that actually mean in simple terms?
Right. Think of it as a very short-term lending rate from the central bank, the People's Bank of China, or PBOC, to commercial banks. They've nudged it down from 1.5% to 1.4%.
Okay, a small nudge, but still a cut.
Yeah.
And the reserve requirement ratio, the RRR.
That one's maybe more impactful day to day. They cut it by 0.5 percentage point. That's the slice of deposits banks have to keep locked up, basically.
So cutting it means banks have more money they can actually lend out.
Exactly. Bloomberg estimates this RRR cut alone frees up about 1 trillion yuan in long-term liquidity. Well, that's a lot of cash in the system.
And the timing. Bloomberg links this directly to the trade war with the U.S. heating up again.
Absolutely. Governor Pan Gongsheng announced it, and they had this whole briefing with other top regulators. It's clearly a coordinated effort to cushion the economy from those tariff impacts.
And the head of their securities regulator, Wu Qing, even mentioned the tariff hit on listed companies.
He did. Bloomberg highlighted that. He acknowledged both direct and indirect impacts. So, yeah, the pressure is definitely being felt by Chinese businesses.
Makes sense. So the reverse repo cut is effective Thursday, the RRR cut a week later.
That's the timeline Bloomberg reported, yes.
How did the markets react initially?
Kind of mixed, actually. The offshore yuan weakened a bit, which you might expect with easing. Bond yields ticked up slightly. Stocks, they actually gave back some early gains. The Hang Seng China Enterprises Index, the CSI 300, both pulled back.
Maybe the market was expecting more, or perhaps focusing elsewhere.
Could be. Jason Chan at Bank of East Asia, quoted by Bloomberg, suggested exactly that the market's focus is really shifting to the upcoming trade talks in Switzerland. There's caution, uncertainty.
Right, the talks are key. Now, you mentioned this was a coordinated effort. Bloomberg said there were other measures, too, beyond the main rate and RRR cuts.
Oh, yeah, it was quite the package. Pan listed like a dozen different things, according to Bloomberg. Lower rates on various special lending programs, like for policy banks, for tech firms.
Well, more targeted support them.
Very much so. They cut the RRR for auto finance companies all the way to zero, cut rates on housing provident fund loans, boosted the quota for tech re-lending loans, even new tools for services consumption, elderly care.
Wow. So really trying to hit specific sectors. Tech, consumption, elderly care. Those sound strategic.
Definitely. And support for agriculture, small businesses.
Right.
They even mentioned tools to support the stock market and a new risk-sharing thing for tech bonds. It's comprehensive.
Pan still described the overall stance as moderately loose, though, right? What's the signal there?
Yeah, moderately loose. It means they want plenty of liquidity, low borrowing costs, keep the economic engines oiled, basically, but maybe not full-on, pedal-to-the-metal stimulus.
Got it. Chana at Saxo Markets had an interesting take in the Bloomberg piece, calling it groundwork for resilience, maybe even retaliation.
Right. Her view was interesting. Like, this isn't just about defense. It's about building strength for whatever comes next, whether that's reform or pushing back harder on trade. And focusing on tech and consumption fits that longer-term picture.
And the last time they did something this broad was back in September, Bloomberg noted. So it's significant.
Definitely significant.
Bloomberg Economics called the package stronger than expected, a real signal of commitment. But they also stressed the need for fiscal follow-up. Why isn't monetary policy enough on its own?
That's a classic point. Monetary policy, cutting rates, adding liquidity, it makes borrowing cheaper, encourages investment. But fiscal policy, government spending, tax cuts that puts money more directly into the economy, into pockets, into projects.
So you need both, especially if you're trying to boost domestic demand because exports are threatened.
Exactly. And boosting domestic demand is China's stated goal, especially with the U.S. trade situation. So fiscal measures might be needed to really make that happen. Bloomberg Economics certainly thinks so.
Lin Song at ING Bank also made a point about the timing, didn't he? Relating it to the talks in the yuan.
Yeah, he told Bloomberg the timing was quite suitable. Doing it now shows resolve before the talks start. Plus, the yuan had strengthened a bit recently, giving the PBOC more room to ease without triggering, major capital flight concerns. It looks strategic.
And the financial regulator, the NFRA, is chiming in too, pledging support for the property market, insurers, small companies.
Right. Bloomberg reported that. Light from the NFRA promised policies for property financing, easier rules for insurers' investments, more funding for small firms. It really reinforces that coordinated, all-hands-on-deck approach.
It feels like a shift from their recent focus on just managing the yuan and bond market stuff.
It does. Bloomberg analysts noted that shift too. The priority now seems squarely on growth and stability in the face of these external pressures. China's got that 5% growth target, and without stronger stimulus, it could be at risk.
Francis Chung at OCBC, quoted by Bloomberg, called it a card to play against the tariffs. That sums it up quite well, doesn't it?
I thought so too. It's like saying, we can support our own economy, we have tools, we can withstand this pressure. It potentially strengthens their hand going into those trade talks.
Okay, staying with China, but shifting slightly gold. Bloomberg also reports China kept buying gold in April. That's 6 months straight now.
Yeah, another consistent trend. They added around 70,000 troy ounces in April. Over the last 6 months, it's close to 1 million ounces, maybe 30 tons.
Why this steady buying, especially with gold prices near record highs?
Two main reasons, according to Bloomberg. One, classic diversification away from the U.S. dollar, which makes sense given the geopolitical climate and trade tensions. Two, gold is seen as a safe haven, a tangible asset, especially when there's uncertainty.
And it's not just the PBOC, right? Chinese investors are interested too.
Seems so. Bloomberg mentioned record trading volumes on the Shanghai Futures Exchange, and the PBOC apparently gave banks bigger quotas to import gold. So yeah, demand looks strong domestically too, supporting the central bank strategy.
Goldman Sachs had some analysis on this, mentioned in the Bloomberg piece. They see central bank gold buying as a bigger trend now.
They do. They pointed out purchases have jumped like 5-fold since 2022. They link it partly to the freezing of Russia's reserves, kind of a wake-up call for countries about relying too heavily on the dollar system. Goldman thinks it's a structural shift.
Interesting. Did they estimate how much gold China holds relative to reserves?
Yeah, Bloomberg cited Goldman's estimate of around 8% for the PBOC. That's actually below the global average and way below some developed countries. Goldman even calculated it could take years for China to reach, say, a 20% allocation at the current pace. Suggests this buying could continue for a while.
Okay, so China's easing policy, buying gold, clearly preparing for something. Let's flip over to the U.S., the Federal Reserve. Bloomberg previews their meeting expectation is they hold rates steady.
Yeah, that's the strong consensus reported by Bloomberg. Hold state.
Main reason being?
Uncertainty. Specifically, uncertainty about the Trump administration's trade policies and the impact of these new tariffs. They want to see how things play out.
Even though consumer confidence might be dented, but inflation cooled a bit and unemployment steady, it's a mixed bag of data.
Exactly. It's not a clear picture. So the Fed's likely message, according to Bloomberg, will be, policy is well placed, we're watching everything, but we're in no hurry to move rates either way. Patience is the word.
Which, as Bloomberg notes, might not sit well with President Trump, who keeps calling for cuts.
Probably not. But Sarah House from Wells Fargo told Bloomberg the hard data is still mostly holding up, giving the Fed cover to wait. The trade uncertainty just adds to that rationale for caution.
So the Fed meeting concludes, Powell holds a press conference. What are markets pricing in versus what economists expect? Bloomberg mentioned a gap there.
Right. Futures markets, according to Bloomberg, are pricing in cuts starting maybe as early as July. But economists surveyed think it's more likely to be September and maybe fewer cuts overall.
Why the difference? Markets betting on a bigger hit from tariffs.
Possibly. Markets might be more focused on the downside risks from trade. Economists might be weighing the still solid labor market and above target inflation a bit more heavily. Bloomberg Economics expects Powell to actually push back against those aggressive market expectations for cuts. He'll likely stress price stability.
And the statement itself. Likely to keep the rate target at 4.25% to 4.5%. Repeat the usual language about being attentive to risks.
Pretty much. Bloomberg expects that. They might tweak the language on economic activity slightly, though. Given the first quarter GDP number showed a contraction partly due to imports, they can't really say growth is solid anymore.
Ah, right. So maybe acknowledge the slowdown slightly, but still emphasize the strong labor market.
That seems like the probable path, yeah.
Yeah.
Highlight the jobs market to justify the wait-and-see stance while acknowledging the outlook is, uncertain. High uncertainty will likely be a key phrase.
Investors will be hanging on Powell's press conference then, looking for hints about cuts. Diane Swank at KPMG made a point, reported by Bloomberg, about how past inflation scares might influence the Fed now regarding tariffs.
Yeah, that's a really important point Swank raised. The Fed has scars from past inflation battles, right?
Yeah.
The 70s, the more recent surge.
Yeah.
They don't want to repeat that. So they'll be very careful about tariffs pushing up prices.
Powell's likely to repeat that they need to ensure a one-time price bump from tariffs doesn't become ongoing inflation.
Almost certainly. Swank's view, via Bloomberg, is the Fed won't be too quick to cut rates in response to a supply shock like tariffs, because that risks stagflation, slow growth, and high inflation. That's the nightmare scenario they want to avoid, especially with inflation still above their 2% target.
And Powell will inevitably get asked about Trump's pressure, his criticisms. How does he handle that?
Bloomberg expects the usual playbook. Emphasize independence, focus on the data, stick to the mandate, don't get drawn into political sparring. He's been pretty consistent on that.
Okay, so Fed likely on hold, watching Trode. Meanwhile, MarketWatch has stories showing tariffs are biting specific sectors already. Let's start with gaming. The tariff buzzsaw is coming for hardcore gamers.
Yeah, that MarketWatch piece highlights how the PC gaming world relies heavily on components from China and East Asia, so tariffs hit them fast and hard.
Stephen Burke from Gamers Nexus even made a documentary about it, The Death of Affordable Computing.
He did. MarketWatch mentioned it. He talked to companies. Apparently margins are getting squeezed, threatening the viability of building affordable, custom gaming PCs. Higher prices for gamers seem inevitable.
And it's not just direct imports. MarketWatch also says Rivian, the EV maker, isn't immune, even though they build in the U.S. How does that work?
Well, according to MarketWatch, even with U.S. production and mostly USMCA-sourced parts, Rivian is feeling the chill from the overall economic uncertainty the tariffs create. It affects consumer confidence, demand.
So they lowered their 2025 sales guidance.
They did, yeah. And raised their capital spending outlook, too, citing those tariff concerns. It shows the broader ripple effects.
Supermicro Computer also cut its outlook again, and MarketWatch says they explicitly mentioned tariffs this time.
Yes, another cut to their revenue forecast. And their CEO, Charles Liang, quoted by MarketWatch, specifically said economic uncertainty and tariff impacts may have a short-term impact. So a direct acknowledgement there.
But then you have AMD. MarketWatch reports they expect strong growth despite everything. How are they managing that?
AMD seems confident in their product lineup. Their CEO, Lisa Su, according to MarketWatch, believes headwinds from the macro environment and China sales restrictions will be offset by demand for their new CPUs, GPUs, and especially their AI accelerators.
So strong products in hot areas like AI can potentially override the broader gloom.
That seems to be AMD's bet. They do expect some charges related to the China export controls, but overall, they project strength. Shows how varied the impact is depending on the company and its specific market position.
A really mixed bag indeed. Okay, let's quickly run through some other headlines Bloomberg and MarketWatch picked up. Oil prices rose on the Trade Talk news.
Yep, Bloomberg reported oil extended gains on hopes for the U.S.-China talks. Plus, the EIA cut its forecast for U.S. production, adding support.
Stock futures also liked the Trade Talk news and the China rate cut, but Europe dipped a bit.
Right. The Bloomberg Markets Wrap noted U.S. futures and Asian shares rose initially. Europe was dragged down partly by Novo Nordisk revising its outlook. Also saw weakness in the Indian rupee and a slump in Pakistan's market.
Treasury yields ticked up ahead of the Fed meeting too.
Correct. Bloomberg said traders trimmed bets on aggressive Fed rate cuts, pushing yields up slightly as they expect a slower pace of easing.
And Novo Nordisk, their stock rose even though they cut their outlook. MarketWatch explained that.
Yeah, a bit counterintuitive. MarketWatch pointed out the FDA removed their key drugs, Ozempic and Wegovy, from the shortage list. That's seen as a long-term positive, outweighing the slightly lower short-term guidance. Less competition from compounded versions, basically.
Interesting. What else briefly? Geely bidding for Zeekr, India buying more Russian oil.
Right. Bloomberg noted Geely wants to take its U.S.-listed EV brand Zeekr private. Indian refiners planning to hit the spot market more for Russian crude. Romania trying to calm markets.
And that Bloomberg piece on Western Sahara development after U.S. recognition of Morocco. Plus, MarketWatch had a piece on Buffett investing for 401ks and Lucid sticking to production goals.
Yeah, a lot of other moving parts. The Lucid story noted they maintained guidance despite mixed results. And, of course, reiterating that those high-level U.S.-China trade talks are indeed happening.
Okay, let's try and wrap this up. Key themes today. China easing policy quite aggressively to counter tariff pain, also stocking up on gold, all ahead of crucial trade talks.
Right. Then you have the Fed in the U.S. expected to hold steady, watching the tariff fallout very closely, dealing with political noise.
And down at the company level, a real spectrum of impacts. Some industries feeling the tariff buzzsaw immediately, others like AMD feeling more confident due to their specific products. Markets are reacting, somewhat hopeful on talks, but still nervous.
It really highlights just how interconnected everything is. Trade policy, central banks, company performance, investor sentiment. It's all linked.
So, the final thought for everyone listening, we're seeing this major clash between geopolitical trade actions and monetary policy responses across the globe. How does this complex dance potentially reshape the economic outlook? And maybe, how should it influence how you think about your own investments or financial planning in the coming months? What are the hidden risks or unintended consequences we should be watching for?
That's the big question, isn't it? What levers do policymakers really have, and what happens when they pull them in this kind of environment? Lots to think about.
Indeed, definitely food for thought. Well, that brings us to the end of our deep dive for today.
Thanks for listening.
And we'll see you all tomorrow morning with new headlines from major financial magazines.